Finding the soft landing. Today's inflation and consumer confidence data is adding to the debate over whether the Federal Reserve should take its foot off the gas. Now, the market's still second-guessing Chair Jay Powell and if he's determined to hike the economy into a steep downturn. Now, our next guest has added her voice to the debate in a Yahoo op-ed that she says the Fed should hit the pause button and reassess. Sheila Bair is the former chair of the FDIC and currently serves as a senior fellow to the Center for Financial Stability. Good to see you here. So give us your argument as to why you think the Fed should take its foot off the gas right now.
Right. Well, I think they should hit pause. I'm not saying they shouldn't continue to tighten, but I think they need to take a breather to assess the impact so far of the actions they've taken. You know, to their credit, Jay Powell has been heroic. The Fed has been heroic. They frequently point to Paul Volcker, a personal hero of mine as well. But there are some key differences between then and now. For one, we've had this very protracted, 14 years of near zero rates. There's been a lot of buildup of leverage in the system. We didn't have that problem during the Volcker years. The rate of increase also is much more profound. You know, they've taken rates from near zero to over 4.25% in just 1 year. That's like a 6,000% increase. Volcker did, significant rate hikes. They were more long annual hikes of 50%. And then finally, the tool they're using, I think, is arguably much, much more powerful than the traditional tools that were available during the Volcker era. Now they essentially pay banks and other financial intermediaries not to lend. So they give them a nice, safe place to put their own money, their reserve accounts, or something called a reverse repo. They can get a nice return on that just by letting their cash sit idle. But that really has a powerful incentive to constrain credit in a way that I don't think we fully understand. This is a new tool they've never used before for this kind of a significant tightening. So yes, all of those uncertainties and differences, I think you've been heroic, good for you. Hit pause, take a breather, see the impact this is having on the economy before you go forward. And then you'll have a better sense of how fast you should be going forward.
Yeah, Sheila, it's interesting to read the op-ed that you wrote, sort of doing the point by point that you just laid out right now. But I wonder if we pull back here and we look at the rate of increase. You said 6,000% is kind of what we're looking at right now. Do you think those moves have been justified?
I think they had to act very quickly. I mean, I think there's no sense finger pointing, but they were late raising, right? They didn't do it until early this year. So even though we saw inflation was getting to be a problem in 2021. So they were a bit late. They needed to catch up. And so I understand why they went very aggressive. But I do think there's a question now whether they went too far, too fast. I don't really want to second guess. I think they were late. Given the fact that they did need to play catch up, I don't want to second guess what they've done so far. But I do think now it would be good to hit pause. Another aspect of this where they could try a different approach is focus more on shrinking their portfolio versus just raising short-term rates, the so-called Fed fund rates, which is what they do with this, basically paying intermediaries not to lend. That's a very powerful tool. If they could hit pause on that, but maybe accelerate shrinking the portfolio, especially mortgage-backed securities, that's hardly rolled off at all because the rate of refinancings has slowed so much with interest rates going up. So they might think about selling some securities as an alternative approach. That would be more targeted on the housing market. I know the housing market's under distress too, but the good news is most homeowners are protected. They've got fixed rate mortgages, they've got equity in their homes. I know it's painful for realtors, for mortgage originators, but if you want to have a targeted focus on inflation drivers, and housing's a huge inflation driver, they perhaps through portfolio shrinkage, MBS shrinkage, could do a little more targeted on mortgages and again, take a pause on the short-term interest rate increases, which really has much more dramatic recession risk and labor market risk. One other thing, there's so much focus on Larry Summers and a lot of the other inflation hawks on this, and I count myself as an inflation hawk, maybe not as hawkish as he is, but they're so fixated, and Powell is as well, on the labor market. We had more been to declining wage growth for over a decade after the great financial crisis. Labor markets, wages need to catch up a bit. And hourly wages actually are still, they're not going up on a real basis. So to suggest this is a huge driver and that this is something we have to focus on, which really means if you want to target that, you're going to take the economy into recession. I don't think that's the right way to look at that. Focus on other areas where I think there's more bandwidth to tackle inflation without hurting the broader economy. But the labor force, they had some catching up to do, and we just may need to tolerate that a little bit longer to get our economy at an equilibrium where wages are fully fully compensating the workers for the tremendous contributions they make to our economy.
Sheila Bair, always good to have you on the show, former FDIC chair and senior fellow to the Center for Financial Stability.